Thank you very much, ladies and gentlemen. Thanks for coming. I realise it's obviously been a long day for you, so I appreciate your attendance. Thank you. I'm going to talk to you about non-standard finance. I don't know if many people know about that segment of the financial services market. So we're talking about consumer lending to people who cannot borrow from a high street bank. And it's a pretty large marketplace. So we listed in 2015. We're a main market listed company. And the vision that we set out at that time was to become a leading participant in the sector. The size of the market is around 10 million adults in the UK cannot borrow from their high street bank. So that's the opportunity. So why are we different from any other lender? And there are lots of lenders. I'm sure you see adverts on the television, hear it on the radio. Why are we different? When we lend direct to somebody, we meet the customer. Our experience is when you're lending to someone who is subprime in terms of credit quality, it's all very well just credit scoring them, using your scorecards to assess their creditworthiness, but that only tells you their ability to pay. What's really, really important when you're dealing with someone in the subprime sector is what is their propensity to pay, and we feel that the best way to do that is to meet them. So we're quite different from many of our competitors. We have three business divisions, and I'll come on to talk about each of these in turn. We're taking a leaf out of Jack Welch's book. We're a market leader, certainly a top three player in all three of the divisions. So branch-based lending, we're the number one in the UK, with 64 branches currently open. We're the second largest in guarantor loans. The biggest competitor is a company called Amigo, which announced earlier this month that it's going to list later this month. And we're the number three in home collected credit, with a brand called Loans at Home. Now, each of these divisions is trying to address different segments of the market, and I want to focus on the bottom half of the screen here. You can see that the loan sizes vary quite considerably, in particular from home credit, which is very small loans, about 100 up to £1,000, typically for much less than 1 year. Whereas in guarantor and branch-based lending, we're lending much larger sums between £1,000 and £15,000 in the case of branch-based lending, and £1,000 to £10,000 in the case of guarantor loans, all unsecured. The APRs we charge vary quite considerably as well. Again, the smaller, shorter-term loans attract much higher APRs. The longer, larger loans tend to attract lower APRs, although we are able to cater for people who are near prime or even all the way up to deeply subprime. The average level of income for our branch-based customers is around £30,000, so average income for the UK. But something has gone wrong in their past, so they're credit impaired, which means they can't borrow from a high street bank. At the other end of the spectrum, home credit customers are on low incomes, on average around £16,000, £300, £350 a week. So why are we so excited? Well, because the opportunity is very large. There is significant demand for this product in the UK. As I mentioned, 10 to 12 million adults are just not able to borrow from mainstream banks. So how do we get to that 10 to 12 million people? Well, firstly, there's a large population of self-employed. Obviously, we know, and you can see from the chart there, how fast that's been growing. Self-employed people have variable income. So they might earn £1,000 one month, £4,000 the next month, nothing the next month. And that flow of income is something which mainstream banks just don't know how to deal with. They can't deal with it, so that's an opportunity for us. There's a large proportion of the population are deemed to be low paid, i.e. 2/3 of the median level of income. So the median hourly level of income is around £14, so that means around £9.30 per hour. They are deemed to be low paid, and whilst the proportion has been shrinking, it's still around 18.4% of the total working population. And lastly, there is a large number of people who have county court judgments. If you were ever unlucky enough to get a county court judgment against you, maybe you missed some parking tickets, you didn't pay a council tax, that county court judgment is held on your credit file for 6 years. In the last 12 months, over 1.1 million people received a county court judgment. So if you multiply that by 6, remove some duplicates, you can see there'll be 3 to 4 million people easily that have county court judgments against them that are effectively scored out from the mainstream banks. So very easily you can see how we get to the 10 to 12 million people. So the demand is large and there is a limited pool of supply. All of our businesses are FCA regulated, so very strict regulations, and that is just simply not for everybody. Many companies are sustaining persistent losses. I mentioned a lot of the online providers are certainly losing a lot of money. Some business segments like rent to own, for example, have been in the news recently, have been forced to change their models and proved uneconomic as a result. There's a limited pool of executive talent who know how to do this, how to run these businesses. Bank funding is limited, and I could go on. So there's a strong demand and there's limited supply. So this feels like a really attractive marketplace. At the same time, the macroeconomic environment is really strong right now. Unemployment is at an all-time low, I think figures yesterday. And we've seen strong growth in consumer lending, but it's not in the subprime space. It's actually the near-prime borrowers who've been taking out credit cards, mortgages, car loans. Those are the things which have been really driving the growth in consumer credit. So what about non-standard finance? So as I said, we launched in 2015. 3 years later, we have a really significant business with a loan book of around 250 million. We have 3 business divisions. I mentioned number 1, number 2, and number 3 in branch-based lending, guarantor loans, and home credit. As you can see, we've got around 130 locations across the country. We are growing very fast. Our loan book grew at 30% last year, and impairment came down. So this is the holy grail of lending. So you grow your lending strongly, and the rate of losses that you take comes down. That's as good as it gets. We're very well funded. We've got 260 million of committed funding from the credit funds and from RBS. So that will see us straight through to the end of 2019. A quick snapshot on the numbers. Last year we grew very strongly. Loan book grew by 30%, as I said. Revenue 48%, operating profit 72%, and earnings per share 38%. We also stepped up our dividend. We do pay dividends. We paid 2.2p last year, which was an increase of 83%, having only really started dividend payments the year before. We believe dividends are really important because when we launched the business and raised the money to start with, a lot of the funds that invested in us were income funds. Quick snapshot of the 3 businesses in shape of operating profit, loan book, and revenue. And what you can see here is that the green bars, which is everyday loans, our branch-based lending business, is the real driver. And I'm going to come on to talk about that now. So as I said, it's our biggest business. We are the number 1 in branch-based lending in the UK. We've got 64 branches open today, as you can see, really focused around the main conurbations. We grew the loan book at 21% last year. We have a risk-adjusted margin. In other words, so that's revenue as a percentage of average net receivables after having deducted the impairment losses. So 37%, which is very strong. And we have a low rate of impairment, under 9% of average net receivables. As I mentioned, we think we've got significant growth potential. There is strong demand for this service. If we went back to 2008, prior to the global financial crisis, there were probably around over 400 branches providing non-standard finance through outlets in the UK. Post the financial crisis, all of the prime parent companies like HSBC that owned HFC, you had Citigroup that owned City Financial. They just said, we want to get out of subprime, please close out the books. So all those branches closed, leaving everyday loans as the last man standing. So very large market potential and very few competitors. No regulatory issues. This is a business model that the FCA really likes. Why do they really like it? Because we meet the customer. They really like the fact that we really know more about our customers than most other lenders out there. A bit more about business dynamics in terms of KPIs. What this rather complex slide shows you is you can see the monthly lending volumes are the bars going across the bottom. So you can see for 2015, 16 and 17, and you can see that in each month we've been lending more. But at the same time, the dotted lines on the top show you the average yield on those loans that we're issuing. And as you can see, it's been going up from around 50% when we acquired the business and now is well over 60%. So this is a business we can grow volume and push up prices. Any fool can lend. What about, do we get our money back? What about impairment? The business was launched in 2006, and you can see that in the first 3 years, spent a lot of time getting the scorecard right. And the way you do that is by issuing a few loans with your scorecard, and you think you've got your assessment of credit right. You then actually make some adjustments. You then you increase the volume of loans with the adjusted scorecard, and then you adjust again, and then you issue more loans. And gradually but surely, you improve the quality of your scorecard. In 2009, of course, we're in the midst of the global financial crisis. A lot of the competitors left, and this meant that the company was able to attract the quality customers. And you can see ever since then, the rate of impairment has been very steady, despite the fact we've delivered strong growth over that period. So less than 10% of average net receivables are impaired, and that really is very, very strong. This chart just demonstrates the quality of our loan book, and the fact is that we're not, changing the mix of loans within the business. So we score our customers between A1 plus and A9. What that means is an A1 plus is somebody who is really very near prime, a very high quality credit, someone who we're very happy to lend to at a relatively low APR, and we're happy to give them a large loan. And of course, these are the much more deeply subprime. And as you can see, the mix of the business just hasn't really changed. So we're keeping a very tight lid on impairment. In terms of what happened in 2017, we saw some pretty significant growth over 2016. We opened 12 new branches. We put in a new management team, which has been working extremely well. We added 77 new staff and delivered 1,500 training days to our staff. And this has delivered, a rapid increase in execution. We've been able to share best practice across each of our branches, and we've seen a really positive shift in culture as a result of the change in management. We've also been able to convert more of the leads that we're getting into loans, so we're getting better at what we're doing, and I'll come back to that in a second. All of that combined delivered a 21% growth in our loan book and a lower rate of impairment. Now, this rather complex slide, I hope I'm going to try and translate for you. This is just to explain, where do our loans come from? How do our applications get translated into loans? So at the top, all of our applicants are UK residents. They're earning average income, but in some way they're credit impaired or have got a thin credit file. So they come to us in 3 different channels. Through financial brokers. So if somebody types in, need a loan, bad credit, one of the financial brokers will grab that lead, capture some basic information, and then they'll pass them on to us. So financial brokers represent around 74% of all applications. Then there are people who come directly to Everyday Loans. They find Everyday Loans' website, fill out an application online. That's around 23% of our applications. And then we have a very small number of applications from our existing borrowers. In other words, they're coming back to us again, or they've borrowed from us in the past. But in terms of where the loans are booked, it's basically a third, a third, a third. So we're very well balanced in terms of our source of bookings. But in terms of applications, obviously the majority are coming from financial brokers, and we discard a large proportion of those. All of those go into our credit scoring engine, and we reject around 66%. So if we take out of 100, 66 get automatically discarded at that point. What that means is that 34% are accepted in principle. So these are what we call applications that we're prepared to send into our branches. Now, of those, 12% just drop out. They maybe get a loan from somewhere else. They maybe decide they don't want the loan anymore. Or we can't get hold of them on the telephone, but 22% of the 34 will receive a telephone interview from one of our staff members, verifying the data that they input into their application, confirming the data, making sure that their employer is actually their employer, and once confirmed, we will then invite them in for an interview. Now, between that point of the telephone call and coming in for an interview, we'll lose around 16% because maybe some people don't want to go into a branch. I've got to go into a branch to execute a loan. Why can't I do this all online? Some people will have filled out the form incorrectly. And so we'll eventually get 6% of the original 100 will come into our branches. And we lend to 3. So out of 100 applicants, we're lending to 3. Last year we had a little over 1 million applications. We did 30,000 loans. So we are very selective about who we lend to. And when we compare ourselves perhaps with our online competitors, of course, we're all doing the same sort of thing up to this point. The difference is that we then go through an additional process of meeting the customer, which allows us to sift out some of those who we really don't want to lend to. They're probably lending to around this number here. So we lend to 3% of the 34% that come through, so roughly around 9%. You could think of conversion being around 9%. And you can see that here. So this is what happened last year. So we've got the volume of applications coming into the branches, i.e. of that 34%, this is the number that's coming in. And then the blue line here is showing you what proportion of those loans of those applications are we actually turning into loans. So as I said, it's around 9%. So how are we going to grow this business? Well, the first thing we're going to do is we're going to increase the number of branches. Because there's no question, the more branches we have, the more loans we can write, the more applications we can convert. So as I mentioned, we've got 64 branches now open. That's 11 more than we had last year, and we opened all of those branches by April. We've increased the personnel by 10%, so obviously with more people in our branches, we can write more loans. We're going to increase the volume of leads coming into the network. So talking to more financial brokers, building partnerships with big database companies that can provide us access to consumers. That way we can increase lead volume, and hopefully with higher conversion we convert more of those into loans. Extending our customer relationships, and what we mean by that is often because we will take on a customer at initially a very high APR, they pay well, they then take out another loan, we can offer that loan at a lower APR, and gradually as their credit score improves, ultimately a lot of people will go on and they'll be able to borrow prime because they're no longer subprime. At that point, we've got a decision to make. Are we prepared to reduce further the APR we charge that customer because we've already recruited them? Why wouldn't we do that in order to keep them with us, albeit a lower APR, but now they're less risky than they were before? So that's an opportunity for us. And lastly, of course, increasing productivity. How many loans can one of our staff write in a month? How do we get them to increase that? What efficiencies can we put into the business to allow them to increase their capacity and they can produce more? In terms of the branch economics, I've put 2 charts in here. This one up above just basically shows generically, initially when you open a branch, the business is loss-making, or the branch is loss-making because it has a small portfolio of loans, it's got staff costs, property costs, but gradually that profitability increases so that by month 24, you've got your initial investment back, and thereafter, of course, your cumulative profits grow. You can see that demonstrably by here I've plotted all of our branches, and on the bottom axis is the number of months that each branch has been open, and on the y-axis is the annual profitability in 2017. And what you can see is that the older branches, the branches that have been open the longest, make the most money. So what we expect, of course, is that as the new branches grow and build, they make more money. So this tells you that obviously adding branches increases profitability.
Can I just ask a question?
Please.
Why is your branch operating model more efficient than
say, a Barclays or a Lloyds? Because obviously they're shutting branches, closing.
Well, the key difference is that we lend to customers at an APR rate of anywhere between 24% and 299%, and they want to lend to people at 8%. The economics just don't work. That's it. You know, when you're lending unsecured, so you have no security over the customer, what you have over them is obviously their desire to borrow again in the future, and the fact that they want their credit score to be maintained and not impaired. So those are the two, and obviously ultimately if we choose to, we could litigate if somebody doesn't pay, but on a relatively small loan there's little gain from that because the costs of litigating would almost outweigh what you would get back. So it's about being smart on lending and really proper underwriting. So that's the difference. But this is why the Bank of England is so concerned about consumer lending in the mainstream banks, because when they're lending at very, very small margins, if there is a recession, they don't have anything to protect them from loss. Because if customers suddenly don't pay, they're on a margin of say 3 or 4%, we're on a margin of 37. So we can afford to take some increased impairment and still make money. They can't.
What's the average term of the leases that you're signing for the new branches?
Usually 10 years with a 5-year break.
I mean, that's just been a real sort of hot point at the moment in terms of high street leases.
Yeah, we're really short, very short term, and they're not expensive. We're talking anywhere between 25 and 35,000 a year. So our current second largest division now, guarantor loans. So a guarantor loan is typically taken out by a younger person, somebody who's maybe just got their first job, they're just fresh out of college, they've got their first job, average income 25, 27,000, so earning good money for someone starting in work, but they've got no credit history. They've got no credit file, maybe they've got a really poor credit history because when they're at university they maxed out the credit card and couldn't pay it off, so they can't borrow, and they need £3,500 to buy a second-hand car so they can get to their new job. So if they came along to what would be a subprime lender, they would have to pay a very high APR because they've got no credit history and the lender would deem them a very poor credit risk. By getting a guarantor, usually a family member, they're able to borrow at a much lower APR because the lender knows that if the borrower doesn't pay, the guarantor is legally obliged to pick up the payments. So this was a market that was pioneered by a business called Amigo, which you may have heard of. They do lots of TV advertising. They're the largest player in the market. We're the second largest. And that's a business, their business has grown very strongly since 2006, and they're going to IPO, as I said, later this month. In terms of our business, around 10% of operating profit last year, 21% of total loan book, and around 7% of revenue. Very attractive KPIs. The loan book grew at 35%. The appetite for this type of product, because of course for a younger person getting on the credit ladder, building a credit history at a much lower APR than if they were to borrow on their own, is really attractive. Risk-adjusted margin, again, over 30%, and very low rates of impairment. So this is a really attractive business model, but it's quite complicated because effectively you're writing a three-way loan. You've got the borrower, you've got the guarantor, and you've got the lender. And everybody has to be very clear about what position they're taking in this relationship. Strong demand, as I've said. This chart at the bottom shows you the rate of growth for the market as a whole. Very strong, so 30% compound since 2008, and we see nothing to see that slowing down. If anything, we think it's accelerating. As I said, we're the clear number 2 in the market. And most importantly, this is another segment where the FCA has no regulatory issues. As part of their high-cost credit review that was published recently, they had originally intended that they were going to do a deep dive on guarantor loans, but having regulated the operators in the space, they recognised this is a really good product for customers, and they decided they didn't need to look at it. So that's really good news. 2017, again, a year of dramatic growth for us. Largely driven by an acquisition we made in August of last year. we acquired the number 2 in the market called George Banco. We appointed their CEO as to run our enlarged business. We already had a small guarantor loans business, and we're now in the process of integrating the technology that lies behind the 2 guarantor brands that we have. As I say, grew loan book 35%, record volumes now being achieved every month. We're improving the balance of where those loans are made, and you can see that on this chart, that October, just a couple of months after we bought the business, around half of the business were coming through financial brokers. That now, by the end of the year, that had reduced to around 45%. But in terms of where the business comes from, top-ups are where we're getting existing customers to either refinance or take out another loan. Organic is obviously just coming through straight through the search engines and coming straight to our sites. And a unique opportunity for us is over here, is we've got referrals from everyday loans. So one of the things that Amigo, our biggest competitor, doesn't have, of course, it doesn't have an affiliated branch network that we have. We have lots of customers who come into us in everyday loans, we credit score them, we meet them, we go through income and expenditure, and then we decide that actually they can't afford the loan that they're asking for, but we're able to say, well, if you get a guarantor, we can lower the APR and you can borrow the amount you want at a much lower cost, and then you can afford it. So would you like to speak to our colleagues at Trust 2? So that referrals opportunity is a big potential source for us. Again, just showing you what's happening or been happening to our average loan, to the net loan book, growing very strongly, and we expect that to continue. And lastly, but by no means least, is the home credit business. So I'm sure many of you may have been following what happened to Provident Financial in the past year. They chose to change their business model fundamentally in home credit. That was a massive opportunity for us. We added around 460 new agents, all of whom came from Provident, around 100 staff, all of whom came from Provident, and we grew our loan book by 53% last year. So totally transformational. We opened 20 new offices, so significant investment, significant growth. But this is a market that is not growing. Where we see the opportunity is because obviously of the challenges that Provident Financial has had, and also the fact that there are around 470 very small mum and pop operations. There's an opportunity to consolidate that. And so we see an opportunity for us to build market share. In the latest high cost credit review, basically the FCA has said it recognises the important role that home credit has, and yes, it wants to make some small changes to our operating model, but nothing that's going to materially impact our business. And relative to rent to own, they recognise that borrowing from a home credit company would be a much better consumer decision than borrowing from rent to own. So that was really good. Again, dramatic growth you can see here, and this is really the transformation that came from the addition of the Provident agents who have started to bring across lots and lots of their customers. I'm not going to go through that. That just gives you some numbers on our business. We publish KPIs. These are the operational KPIs that we use to run the business. And loan book growth of over 20%, we're already achieving that in all 3 of our businesses. The other major KPI that we're not yet hitting is return on assets. In other words, EBIT as a proportion of average net receivables. We're not yet above 20%, but we're getting close. And I suspect and hope that we would achieve that in Loans at Home this year. The other 2 businesses will catch up in due course, but we're making good progress on all of our KPIs. The balance sheet, for those of you who are interested in such things, net debt around 197 million as a proportion of our loan book is around 80%. So relatively, I wouldn't say highly geared, appropriately geared. Provident Financial, by comparison, is not a dissimilar number, and we think this is an efficient capital structure for us. We've got loans, debt facilities out till 2023, 225 million, and an RBS facility out to 2022, so no need for further equity to finance the growth that we expect. IFRS 9, for those of you who follow the accounting changes, this is not going to really have a material impact on our business, but the analysts, the sell-side analysts, are quite interested in this, and so I included this in the slide just for completeness. So just to conclude, and then hopefully 5 minutes for questions or so, the market is very large. We have a leading position in the marketplace in our 3 chosen segments. We've got a highly experienced board. CEO is John Van Kuffler, who ran Provident Financial for 23 years, 6 years as chief executive and 17 as chairman. We're fully licensed by the FCA, all businesses. We're very well funded, and we have a top 3 position in all of our markets. So we're growing pretty fast. We're pretty excited about the future. There's some research in the room from Hardman. They're projecting very strong growth over the next couple of years. So happy to take any questions.
A couple of questions. Firstly, about the cost of capital.
Yes.
If you could talk about that. And then the other question would be about the weighted, blended, I suppose, rate that you charge.
Okay, taking the first one first. So prior to August of last year, we had debt facilities with RBS, Shawbrook and Secure Trust Bank. The fact of the matter is that the lending banks have a limited appetite to lend into this space, and we were very quickly going to hit the limits, probably individual limits with our lenders. So we took the opportunity to go to the credit funds. So last August we did a deal as part of the acquisition of George Banco. We increased our credit facilities from around 115 million up to 260 million. And we're paying more for that, but we got 6-year money. So for us, the cost of funding is actually a relatively small part of our overall cost, but in answer to your question, an all-in cost of 9% is what we're paying. But as I showed in the earlier chart, our largest business, the yield on the loans we're issuing are over 60. So yes, funding costs is important, but for us it's a relatively small part of our overall costs. In terms of the blended rate, as you say, it wouldn't really mean anything, because each of the businesses is very different. We've got, our branch-based business doing loans 1,000 to 15,000, 1 year to 5 years in length. And at the other end of the extreme, we've got home credit doing £100 loans over 24 weeks.
So maybe it's easier just to to divide it by those 3.
I think it's better to look at each division separately.
Have you got figures for that?
So again, in terms of average, I showed you the average for the loans written in the branch-based lending business, so it's around 60%. In home credit, our 2 biggest products are the 33-week and the 45-week loan, and they are between 330% and 433%. And I know that sounds very large, but typically we're lending very small amounts for a very short period. So to translate that for you, if you were to borrow £100 for 33 weeks, it would cost you £65. So the customer would pay £5 a week over 33 weeks. Now the important thing to realise about home credit is, in that instance, so they have to repay 165 in total. But if they take 35 weeks or 38 weeks or 45 weeks or 52 weeks to repay, they never pay more than 165. The forbearance is built into the model, and this is why it's a very attractive model for those on very low incomes, because if you've got low or variable income, you're working on a market stall, it snows, you've got no customers, you can't repay your bills. They know with home credit that it's still £5 a week, but they might be able to miss a couple of weeks with no penalty, no additional cost. They just tack it on to the end and pay over a longer period. And that's why they like home credit.
Just a very simple question. Could you give us some insight into how the loans are being used by your customers in each division? And specifically on car loans, do you find that you're able to compete against secured lenders?
So in terms of what customers are using them for, I mean, obviously we try and capture that. I'm not sure you could ever definitely prove exactly what they're using the money for. Our primary responsibility is make sure, is it affordable? Can they make the loan repayments? But typically it's debt consolidation. So they might be combining 2 payday loans or other loans, other debts they've got that might be costing them more money, and consolidating those. Home improvements, emergencies. Car fails its MOT, you need 300 quid, they don't have it. So it's a variety of things, but probably debt consolidation and home improvements are probably the most important one. And then, sorry, your second question?
Do you really compete with secured lenders in car finance?
So people do borrow money from us to buy cars, but they're not, this isn't PCP or anything like that. But again, this is all about being able to assess the credit quality of the customer. For a lot of customers, they would go to a car loan company, but they wouldn't qualify because their credit score would be too low. They might have a county court judgment against them. Again, these are things which because we meet the customer, we can investigate and get to the bottom of. If the reason they got the county court judgment was because their wife got cancer and they spent 2 years not working and then she's better, and then now since then they've actually managed their finances really well, we're happy to lend. But the mainstream lenders and many of the car companies would not be prepared to lend because all they see is they've got a county court judgment and they won't lend. Okay, thank you.